You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Well, if it's a Friday, then I guess it's question and answer day, which means it's the day on which I answer questions that you've recorded by going to talkingrealmoney.com, clicking the contact form, and then recording your questions. And we've got a lot of them, not as many as we had, so we don't have to make this episode as long as the last couple, but we've still got several, and that's a great thing. So thank you for all of those. And also remember, you can call us live on Saturdays during our radio show, which is 3 to 5 Eastern Time, noon to 2 Pacific, at 855-935-TALK, 855-935-8255. Now, let's get to our first question that came in to talkingrealmoney.com.
Hello, Don and Tom. Really like your advice. I like how you don't push Roth conversions for investors who would have to pay the tax from their tax-deferred retirement account. I'm 59 and a half, retired, and all my money is in pre-tax 401k or IRA. I believe if I did Roth conversions, they would be done in the 22% tax bracket. I prefer not to pay any taxes before their time. I think you agree with this. Here's the but. I'm sure you've heard of the Bolden retirement software. When I run the numbers through the software, if I do Roth conversions, my effective tax rate decreases and my total net worth increases. Should I not believe this software? Since we don't know the taxes in the future and I have to pay the taxes with pre-tax money, should I just ignore the results? Either way, the Monte Carlo simulation says I will not run out of money. Thank you for your 2 cents.
Well, that's the good thing, the Monte Carlo simulation. But again, Monte Carlo simulations are only as good as the data behind them, and they can't know the future either. So the odds are good that you won't run out of money, but there's certainly no guarantee that you won't run out of money. And that's the issue with are you going to be better off with the Roth conversion or not? If you can convert in a relatively low tax bracket, like the 22% bracket, and you can pay the taxes out of other money, as you mentioned earlier, and you expect that because your money is growing over time, that you may very well be in a higher tax bracket in the future, then the Roth conversion can make sense. The problem, and again, you alluded to this, the problem is we don't know what the future scenarios are going to look like. We really don't know. That's why we're big fans of having both, and maybe even doing Roth conversions to get some of both, but make sure that you stay within that 22% bracket, that you do some tax planning and you don't creep out of it. But to do some conversions to give yourself flexibility, we don't think is a bad thing. Just don't pay it out of the assets in the IRAs or 401ks. It's pretty simple. Thanks for your call. I appreciated your question, and let's grab the next one, shall we?
Hi, Tom and Don. I really enjoy your podcast and listen to it very often and appreciate all the valuable information that I've learned from it. I'm not sure if this is the type of question that you folks would typically answer, but I wanted to run this scenario by you. I am 64 years old. My wife is 6 years old, and we have a home that is worth about $1.3 million, which has a very nice attached in-law apartment. We'd like to sell the home to our daughter and her husband, but they could not afford to purchase a $1.3 million home. I am offering my daughter instead to purchase the home for $700,000, and with the contingency that my wife and I would continue to live in the attached apartment, which is very comfortable for us for the rest of our lifetime. We would loan them the money at $700,000 at 7.5% interest for a 30-year duration. We currently have a $100,000 mortgage, which we could pay off. They have their own home now, which is valued at $500,000, but it's getting a little small for their expanding family. They would like to keep their existing home as a rental property, which would offset their mortgage payment of $700,000. My rationale for this is that if my wife and I stay in the house, they get the house eventually anyway. I would like to take advantage of some of that equity for our retirement. If I put the property on the market and just sold it for $1.3 million, we would have to pay approximately $260,000 in capital gains, along with a 5% real estate commission of $65,000. That would leave us with a net worth of $1 million. We would still have to find another place to live, and if we were really lucky, we'd find something at $300,000. So that leaves us with a remainder of $700,000. I like the idea that my wife and I have a place to live and that we have this income stream of approximately $4,500 a month. I'd be curious if you think this is a good idea or if it's really a lopsided deal for one party or the other. I would also consider offering the option to refinance after 10 years, the $700,000 with a straight conventional bank. So, again, thank you for all the valuable information that you guys pass on. Really appreciate it.
Wow, there's a lot of stuff going on here. This is very involved. Got a couple of things. First, selling it to them below market value does incur a gift tax liability. However, that can be easily taken care of with your lifetime estate exemption. Doesn't even approach it. So that's not, so you would have about a $500,000 gift in there, but that's okay. That's not a big deal. Is it fair to both parties? It's fair to both parties if both parties agree it's fair. If you feel it's fair and they feel it's fair, then it's fair. It doesn't sound blatantly unfair. You're getting a lifetime's worth of rent basically prepaid. But there are this is one of those situations where I think it's complicated enough that you need to make sure everything is drawn up properly. And this is where I would definitely have a real estate / tax attorney involved in the process to make sure everything is done properly. There's just too many places you could be tripped up in this. One of them is the capital gain. Because in essence, you're selling it for $1.3 million. Do you in fact have a capital gain? Because you're gifting them. And I am not a tax attorney. I don't even want to get into that. And another question that comes to mind is, why are they keeping the other house to generate rental income to pay the mortgage payments at 7 and something %? Why don't they just sell the other house? Do they want to be landlords? Is this something they enjoy doing? Maybe. It's a business, though. Do they want another business? There are some details missing. I would seriously look at selling the other house that they have and taking that money and giving it to you guys. But this has got to have a lawyer involved. Absolutely must have a lawyer involved. There is no doubt about it. Don't just do this through a real estate agent. You need somebody who knows real estate and tax law, because there are too many I's that must properly be dotted and T's crossed. So get a good attorney. And thanks for the question. And I wish I had a better answer, but yeah, you can do this. Yes, of course you can do it. It's just what might other ramifications be in the future. I don't see the gift tax issue being a big one, but some of the other issues I think need to be addressed. Thanks so much for the question. I'm glad you sent it in. And remember, you can send them in at talkingrealmoney.com on the contact form, or you can call us on Saturdays at 855-935-8255, starting at 3 p.m. Eastern Time, noon Pacific Time. Next question.
Hi, Tom and Don. This is Bob from sunny Lake Alfred, Florida. This question would be for Don, since I'm recording it. Quick background: retired military and Social Security pension at this point. 74, taking RMDs with annual rebalancing in January. When I retired from my final job, I moved my 401k account or rolled it over to my Vanguard IRA. At that time, that was in 2015, strictly mutual funds, 70% VT WAX, total world equities, and 30% VB TLX for the bond fund portion of it. Finally started listening to Paul Merriman and Talking Real Money, and along the line I decided to reduce my total world equity to 60% and added 10% small cap value mutual fund VSIAX. Then last year in January, I finally took the plunge and moved everything over to ETFs. When I did that, instead of going to VT, I used VTI, which is total US at 25%, VXUS, which is total international at 25%, VBR for the small cap value at 10%, and then BND for the fixed equity or fixed bond portion at 40%. That takes care of my IRA. My real question involves my brokerage account. When I set up the brokerage account, it wasn't all that long ago, so it was straight ETFs from the get-go. And I set it up with VT, total world equities at 55%, VTV, large value, 15%, VB, small cap at 15%, and VBR, which is small cap value at 15%. With the last couple of weeks, I listened to a podcast. Paul Merriman and Rick Ferry were debating the pros and cons of small cap value. And Rick Ferry mentioned that if you should not necessarily use VT as one of your for your equity, because there's an issue with, or well, I should say, there's not really an issue. It's VT is made up of 65% US, 35% international. And he mentioned that the foreign tax credit is only available if your fund that you're looking at has more than 50% of foreign companies. There's made up of that. My question would be, if that's the case, or is that the case, do I have an issue with that? If so, then am I going to face a large taxable issue when I start cashing out some of that VT? If so, then I think I would probably wait till near the end of the year and get rid of or trade in my VT for VTI and VXUS, and 50% this year and 50% next year, just to break up the taxable issue. So that's my question. Foreign tax credit, is that an issue or not? Thank you.
You're welcome. And Lake Alfred, my wife goes down there all the time to the barn in Lake Alfred. Rick Ferry likes to stir the pot. I do too. So, pot calling kettle black. But this is much ado about nothing. The foreign credit is pretty small. I believe on VXUS, it's about 0.2% per year of the, maybe even less, of the portfolio value. So the tax break to you is going to be about 5 basis points. If you have billions of dollars, yeah, we're talking real money. If you have hundreds of thousands, we're not talking that much. You can make the change. It's not going to hurt. The only thing that it does is makes rebalancing a little bit more complicated, but if you're okay with that, making the change will save you a teeny tiny bit of money. But again, I think this is much ado about a whole lot of nothing. Record your questions at talkingrealmoney.com or call us on Saturdays at 855-935-TALK, and it's question time again.
Hey, this is Charles from Alabama. I just listened to the show that dropped May the 5th. About 25 minutes in, Tom made the statement that he was 63% invested in the U.S. and 47% international. So my question is he trading on margin, or do you have a wealth multiplier that we need to know about? Thank you.
Yeah, he does. No, he has a special deal. He's like a wizard. He's a money wizard. Wait, hold on. I know what the explanation is. He misspoke. He just misspoke. That's all. He's not on margin, and he doesn't have a magic money multiplier, although it is a very alliterative phrase. I like that. Thanks for your question. Let's do one more. We've got time. We've got lots of time. Let's do another question that came in at talkingrealmoney.com.
Hey, Don. This is Michael in Houston again. Thanks for your help last time with the questions about the IRAs. Have a little bit of a different question this time. So it's just a quick summary. So I'm married. Both of us are in our mid-30s. We have one kid. We have a house with a mortgage that we currently pay for, and saving for retirement, all that kind of stuff. We are trying to find basically a way to get a more holistic look at our finances. And so short version of the question is, if you were in our situation, what would you do? Who would you go to for that? We are not really needing retirement advice. Like, our portfolios feel fine. We're also not really needing tax advice. We're really looking for, again, like a holistic view of where our financial picture is at. The reason I'm asking is it feels like we're doing everything right, but we're also doing everything, if that makes sense. So we are paying down our current mortgage. When interest rates were super low, we refinanced, following the advice of another financial personality. We refinanced to a 15-year. That, I think, was a mistake in hindsight. Just makes things feel a little bit tight with everything else. We're also saving cash for a down payment on a new house to move to, because we want to expand our family further. We are saving for retirement, maxing out one 401k, both IRAs, and then just a small percentage of the other 401k, and saving for college. And then, after all those things, it just feels kind of tight. Both of us understand that the tightness is coming from just like artificial restriction on our part, right? Like, we're trying to do a lot all at once. But at the same time, we're both just kind of feeling like it's hard to pick what to give up, if that makes sense. Like, when we talk about sacrificing any one of those items, it's kind of like, well, you're mortgaging one for the sake of the other, if that makes sense. So, just would be curious as to your thoughts. Like, again, what would you do in our situation? I know Appella does some free consults. I've heard of Domain from some of the other podcasts. I've heard of some other companies. So I'm really not looking for like an asset manager. I'm looking for more of just like guidance, maybe permission to take our foot off the pedal a little bit in some areas or lean into some others. So thanks again, you guys. Let me know.
So you're a little bit of everything, everywhere, all at once. You're a movie. Yeah, you have permission to take your foot off the gas. I mean, that sounds like what you're looking for. You're trying to do everything when you're probably better off focusing on one or two things. And at your age, the thing that you should be focusing on ain't the house. You should not be paying down that mortgage, and you're right. You probably shouldn't have refied it to 15, and I know who told you to do that. All debt is not bad debt. In fact, you probably took a very low interest rate mortgage and made it monthly a lot more expensive, which would have put more money in your retirement account if you weren't putting it into mortgage payments on a house that you're not going to live in for the rest of your life. We've already established that. You're not going to live there, right? You're going to buy another house. I don't know why we keep doing this. Well, pay off the house. No, do not pay off the house. unless you have a ridiculously expensive mortgage, like, over 7. You, at your age, you guys, your sole goal should be to save money for your retirement, number 1, and to save money for your children's education, number 2. That's it. Pay the bare minimum on that darned house. Have no credit card debt. Doesn't sound like you do. And it doesn't sound like you're really doing anything else, but it does sound to me like the house is the thing that's throwing you off. And that's because of that other guy who emphasizes no debt. Well, all debt's not bad debt. Most debt's bad debt, but not all debt's bad debt. I love my mortgage debt. It's 2.5%. I would never pay that thing down. I will never accelerate it. Am I going to live here until I die? Odds aren't good. They're just not in favor. So I don't know why we keep doing that. The only reason you want to pay off a house is for lifestyle issues, because you want to live there and you want to feel like it's covered should the worst happen. But we also have to remember that we never really own our house. The insurance company is going to get paid. The taxes have got to get paid. And so you're still going to be paying somebody for the place in which you live. I would truly, because I know the people, I don't know anybody else out there, but I do know the people at Appella, and I do know that we don't push people to buy our services to become a client. Of course, someday you probably will need to be a client. So there's a method to our madness. If we help people free, really free, without any obligation or anything, then those people are far more likely to become a client down the road or suggest their parents start using us. But in your situation, take your foot off the gas and the brake. You see, you're kind of driving with your foot on the brake, the gas, and the clutch. Just put your money on the accelerator and let the rest go. Build that retirement account. Build your kids' 529s. Thank you so much for your question. And go to talkingrealmoney.com and set up an appointment with one of our advisors, and I promise they won't push you to buy anything. I promise. No one's ever called me on that. And Tom and I have been doing this for about 15 years, this show. We've done others before that. Oh, yeah, and I forgot to mention, a podcast that I did a guest slot on that is called Personal Finance for Long-Term Investors, is now online. So if you want to hear me in another interview talking about annuities, go check it out. It's on all the podcast services, Apple, Spotify, all of those. It's called Personal Finance for Long-Term Investors, and the host is Jesse Kramer. And he's pretty good. So go check it out. Thank you all for being a part of the Friday Q&A show. And I hope you have a great weekend, and call us on Saturdays at 855-935-TALK, 855-935-8255, or send your questions in at talkingrealmoney.com on the Contact Us form. And remember, you can come here to this podcast service almost every day for a new episode of Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?